Income tax. It is the most widely known tax in the world, applied to the money a person earns over the course of a year. Governments began formalizing it in the 19th century, with Britain introducing one of the earliest versions in 1799 to fund wartime expenses. The core idea is straightforward. The more you earn, the more you contribute. Most countries use a progressive system, meaning higher earners pay a larger percentage of their income. It funds schools, hospitals, roads, and almost every public service people rely on daily. Payroll tax. Unlike income tax, this one is taken directly from an employee's wages before they even see their paycheck, and employers also contribute a matching portion. It exists specifically to fund social programs like retirement benefits, unemployment insurance, and healthcare. In the United States, Social Security and Medicare are largely financed this way. Workers often notice it on their pay stubs without fully understanding what it supports, but it forms one of the financial backbones of the social safety net in most developed nations. Corporate tax. This is the tax applied to the profits a company generates. Once a business subtracts its operating costs, salaries, and expenses from its revenue, what remains is taxable income. Governments take a percentage of that. The rate varies significantly by country, and over the decades, many nations have lowered their corporate tax rates to attract businesses and encourage investment. The debate around it is ongoing. Some argue lower rates grow the economy, while others believe profitable corporations should contribute more to the societies they operate in. Capital gains tax. When someone sells an asset for more than they paid for it, the profit made on that sale is called a capital gain, and in most countries, that profit is taxable. This applies to stocks, real estate, artwork, and other investments. The rate often depends on how long the asset was held. Many governments offer a lower rate if the investment was held for more than a year, encouraging people to think long-term rather than trade rapidly. It is one of the more debated taxes because it affects both wealthy investors and everyday people who sell a home or inherit shares. Sales tax. Every time a purchase is made at a store or online, a percentage of that transaction may be added on top of the listed price. That extra amount goes directly to the government. Sales tax is common in the United States, where individual states set their own rates, meaning the same product can cost a different amount depending on where it is bought. It is a consumption-based tax, so people who spend more naturally pay more. Critics point out that it can place a heavier burden on lower-income households who spend a larger share of their earnings on everyday goods. Value-added tax. VAT works differently from a simple sales tax, even though both ultimately affect consumers. Instead of being added only at the final point of sale, VAT is collected at every stage of the production process. A raw material supplier, a manufacturer, and a retailer each pay tax on the value they add. However, businesses can reclaim the VAT they paid on their inputs, so it is the end consumer who bears the full cost. It is the standard system across most of Europe and over 160 countries globally, valued for its efficiency and its resistance to tax evasion at individual stages of trade. Excise tax. This is a targeted tax placed on specific goods rather than general purchases. Alcohol, tobacco, fuel, and gambling are among the most common targets. It is built into the price of the product itself, so consumers often pay it without realizing it is separate from the base cost. Governments use excise taxes for two purposes: to generate revenue and to discourage the use of products considered harmful or environmentally costly. The reasoning is that if something has a social cost, the price should reflect that. It is one of the oldest forms of taxation used by governments for centuries. Property tax. Owning land or a building comes with an annual obligation in most parts of the world. Local governments assess the value of a property and charge the owner a percentage of that value each year. The money typically funds local services, fire departments, public schools, parks, and infrastructure within the community. Property values fluctuate over time, and so do the tax bills. Homeowners in rapidly growing cities often find their tax bills rising significantly, even when their financial situation has not changed, simply because the land around them has become more valuable. Estate tax. When a person dies and leaves behind significant wealth, property, cash, investments, the total value of that estate may be subject to taxation before it is passed on. Estate tax is applied to the deceased's assets above a certain threshold. It exists in relatively few countries, but tends to generate strong opinions. Supporters argue it prevents extreme concentrations of wealth from passing undisturbed through generations. Critics contend that assets being taxed again after already being taxed during the person's lifetime is fundamentally unfair. The United States, for example, applies it only to estates above a multi-million-dollar exemption level, inheritance tax. While estate tax is charged against the estate itself before distribution, inheritance tax is paid by the people who receive the assets. The distinction matters because the obligation falls on the beneficiary rather than the deceased's estate. Different heirs may pay different rates depending on their relationship to the deceased. A spouse might pay nothing, while a distant relative faces a higher rate. Countries like the United Kingdom use this approach, where the tax is based on what each individual receives rather than the total value of what was left behind. Customs duty. When goods cross international borders, governments often impose a charge on those imports. This is customs duty, and it has existed in some form for thousands of years. Ancient empires collected fees on goods passing through their ports and trade routes. Today, it serves two purposes. The first is revenue. The second is protection. By making imported goods more expensive, governments can shield domestic industries from foreign competition. The rates vary by product type and country of origin, and international trade agreements are often negotiated specifically to reduce or eliminate these charges between partner nations. Carbon tax. This is one of the newer forms of taxation in wide use, built around the idea that producing carbon dioxide has a real cost to the climate, to public health, and to future generations. A carbon tax places a price on greenhouse gas emissions, usually at the source, fossil fuel companies, power plants, or heavy industry. The goal is to make high-emission activities more expensive and push businesses and consumers toward cleaner alternatives. Some governments return the revenue directly to citizens as a rebate. Others invest it in green infrastructure. It remains one of the most politically contested taxes globally, sitting at the intersection of economics, science, and long-term policy.